بسم الله الرحمن الرحيم والصلاة والسلام على أشرف المرسلين سيدنا محمد نبي أمي وعلى آله وصحابته أجمعين. أما بعد, dear my student, this is the second lecture of our course. In this lecture, we are going to discuss one of the important topic in finance. It is called the financial environment. By the end of this chapter, the student will be able to understand the following elements. Number one, what is financial environment? The main components of financial environment, the concept of financial markets, the concept of financial institutions, the main function of financial markets, the main function of financial institutions, different types of financial markets, and finally different types of financial institution. Let us start by the first part, which is the definition of financial environment. What is the financial environment? In general, the firm that require fund from external sources, they could able to obtain these requirement from different three sources. The first source of obtaining the required fund is through a financial institution. The second source of getting the required fund is through the financial markets, or finally the firm could require its required fund through private placement. Therefore, in this lecture, we are going to discuss the main components of the financial environment. In general, we could split the financial environment into two parts. The first part is the financial institution, and the second part is financial markets. Let us start by the first part, which is financial institutions. What is the definition of financial institution? Financial institutions can be considered as a certain type of intermediaries. Intermediary that channel the savings of individual, business, and governments into loan or investment. In this relationship, we have two partners. The first one is the supplier of this fund, and the second one is the demander of the fund. And if you give a look for any society or economy, you will have two partners. The first one is the suppliers, the second one is the demanders. The suppliers, they have surplus of fund. The demanders, they have shortage of fund. In this relationship, the financial institutions play very important role in channeling the surplus of fund from the suppliers to the demanders who require or who are facing the shortage of fund. In both of cases, suppliers and demanders They could be individual, they could be business, and they could be government. However, in generalize, individuals could be considered as net suppliers of funds, while business and the governments are net demanders of funds. The second component of the financial environment is the financial markets. Financial markets can be defined as specific forms in which suppliers of funds and demanders of funds can transact business directly. This is why we could consider financial market as a direct mechanism of transferring the fund from suppliers to demanders directly. It's a direct mechanism. And this is actually the main difference between financial markets and financial institutions. Financial markets can be considered as a direct mechanism of transferring the funds from suppliers to demanders. However, financial institutions can be considered as indirect mechanism of transferring the funds from suppliers and demanders. This is why financial markets can be described as a direct financing mechanism, while financial institution can be described as indirect mechanism of funding. In the financial markets, actually, we have different types of securities. Some of these securities could be in a shape of short-term marketable securities, which takes place in the money market, while the other type of securities, it is long-term securities, and those are taking place in the capital market. In using the financial market as a direct mechanism of funding, this could be done by two ways. The first one is through public offering, or could be done through private offering, or what we call private placement. But when we are going to use the financial market, we could use it through private offering or through public offering. What is the main difference between them? The private placement refer to the sale of a new security directly to a specific investor or a specific group of investors. This will be known as private placement. But in the case of public offering, we are going to sell either bonds or stock to the general public, and this is the main difference between private placement and the public offering. This is very important thing to take in your consideration in the financial market. To summarize the basic function of financial markets and the financial institution, and to explain the basic differences between financial market and the financial institution, let us go to the following figure. As you see, this figure explain and show flows of funds through the financial system. As you see, the financial system is divided into two main components. We have financial markets and we have financial institutions. In the using financial markets, This will be known as direct finance mechanism. Direct finance mechanism where lender or savers, they could be in the shape of households, could be in the shape of business firms, could be in the shape of government and foreigners. Those lender or saver, or what we call suppliers, they have enough and surplus of fund. We need to channel this surplus of fund from the lender and or saver to the borrower or spender who are in a shortage of fund. This could be directly done by using financial market. This is why financial market can be described as a direct financing mechanism. On the other hand, we have financial institutions, or sometimes it's called financial intermediaries. Financial intermediaries, they play in direct finance mechanism by transferring the funds from lender or saver to borrower and spenders indirectly, where the financial institutions play the role of an agent between the two partners, between lenders and the borrower, or between the saver and spender. And this figure is showing you the main components of any financial system and differentiate between those components, the differentiation between financial intermediaries and the financial institutions. When we mean financial markets, you must be aware of what is the structure of financial markets. Actually, we could classify financial markets into different categories based on different perspectives. As you see, we could classify financial markets into primary market versus secondary market. Second, we have another classification, money market versus capital market. Third classification, we have foreign exchange market. Fourth classification, we have spot markets versus future market. Sixth classification, we have broker market versus dealer market. And finally, we have what we call international capital market. So we are going to explain the main meaning of each one of them and the main difference between them. Let us start by the first classification, where we classify the market into primary and secondary market. Actually, as we explained before, primary market, it's a market where we are going to issue the security for initial time, for the first time. But if you would like to issue security, if you would like to issue financial instruments such as stock and bonds, and you are going to issue it for the first time, this will be done in the primary market. And this typically involves an investment bank who underwrites the offering. An investment bank plays very important role in giving you the assistance for your firm, to help your firm to issue the security by conducting the main activity of underwriting and offering. But after we issued the stocks and bonds in the market, so this means that these securities are already existed in the market. Any further trade among investors on these securities, this will be done in what we call secondary market. So if we would like to differentiate between primary and secondary, in very short, primary, it's a market where we are using it for issuing a new security. But in the secondary market, it's a market where security previously issued, and we can use this market to buy and sell already existed security, and this is the main difference between primary market and the secondary market. One of the very famous market of the secondary market, it's NASDAQ and NYSE, New York Stock Exchange. Another classification of financial market, we could classify the financial market into money market versus capital market. What is the money market? The money market, it's a market that could be used for trading debt securities with maturities of 1 year or less. So if the maturity of your security is 1 year and less, it will be traded in money market, such as CD, such as US Treasury bill. Actually, in this market, you will find many securities that could be described as short-term debt instruments, such as US Treasury bill, such as commercial paper, such as negotiable certificates of deposit issued by financial institution. This type of market is very attractive among investors. Why? Because in this market we are trading the marketable securities that have small risk attached to it. This is why it's very known and it's very attractive for many investors, particularly small investors, because the lower risk attached to it. Another important instrument that could be existed in money market, we have, for example, euro currency market. Euro currency market, it's a certain type of short-term bank deposits denominated in the US dollars or other marketable currencies. Such a type of euro currency market has grown rapidly because it is unregulated and it meets the needs of international borrowers and lenders. So the euro currency market can be considered as an equivalent of the domestic money market, but it's an international form, and you must be aware of this. Against the money market, we have what we call the capital market. Capital market, it's a market that could be used for for trading security, but a main characteristics of these securities are long-term maturity. Yani in the capital market, the key capital market securities are bonds, which is the long-term debt, and common and the preferred stock. Those type of security, their main characteristics can be considered as long-term assets. But if you would like to invest in capital market, you must be careful that This type of securities are certain type of long-term asset, and you must be aware of this. Give a look. This is an example of different securities that could be existed in money market and the capital market. As you see, one of the very famous instruments that could be existed in the money market is the 3 months treasury bill. 3 months treasury bills. This is a certain type of securities, and it will be existed in the money market. Another type of securities, such as U.S. government long-term bond and corporate B capital 2A small bonds. This is those are examples of long-term assets because they have long-term maturity, and it will be traded in capital market. But this is the main difference between money market and the capital market. As you see, according to the average, our expected rate of return on average over a number of years from 1950 to 2010, you will find that on average 3 months treasury bill that will be traded in the money market. Of course, it is less risky than other type of securities that are traded in capital market. As you know, increasing in time, increasing the maturity will increase the level of risk, so the expected rate of return will also be increased according to the relation between risk and return, and you must be aware of this also. But as you see, we have different classification of financial market. The first one, we have a primary market, secondary market, and we understood the main difference between them. The second one is the difference between money market and capital market, and what are different securities traded in this market. Another special case of market, it's called FX market, or what we call foreign exchange market. In this type of market, we are trading one currency for another one. For example, we are trading dollar for yen, trading dollar for British pound. We are trading dollar for euro, and so on. But as you see, in this type of market, we are trading one currency against another currency. You must take in your consideration this foreign exchange market can be further split into 2 subtypes of market. The first one, it's called the spot FX market. What is the spot FX market? This is the market where we are trading between 2 currencies, and we agree that there is an immediate exchange of the currency at the current exchange rate. But if there is immediate exchange of currencies at the current exchange rate, this will be considered as spot FX. Vice versa of this market, we refer to it forward FX market. Forward of FX market, it means that we are going to exchange of 2 currencies at specified date in the future at specified exchange rate. Yani we are signing a contract. This contract enables us to buy our trade between 2 currencies at a specified exchange rate, but a delivery it will be done on a specified date in the future. This is called the forward FX. But again, the forward FX transaction involves the exchange of currencies at a specified date in the future at a specified exchange rate. At a specified exchange rate, this is called forward FX market. Also, another classification, we could classify a market into spot market versus futures markets. In a spot market, sometimes we refer to it by cash market. Either we refer to it as a spot market or we refer to it as a cash market. What is a spot market or a cash market? It's a market where financial instruments or commodities are traded for immediate delivery, and this is will be contrasted with the concept of futures market. Futures market, we agree to trade two currencies or more or traded commodity, but delivery will be due at a later date, and will be determined at a specific date in the future. You must be careful. Most of spot market, when I say it's immediate delivery, in most of cases it will take this rule, T, sometimes T plus 1, T plus 2, T plus 3. What is the 2 plus 1 or T plus 2, T plus 3? This is a reflection of a time where the transaction will be done, but it is still be considered as immediate delivery or a spot market. يبقى why the official transfer of fund between a buyer and seller sometimes could we take sometimes, such as T plus 2 in the stock market, and most currency transaction both parties are agree to trade it right now, and this is the spot market. The vice versa of spot market, we have what we call a future market. Future market, it's an auction market in which all of the participants agree to buy and sell a specific commodities or a specific futures contract, but delivery will be on a specified future date at a price set today. This is the future market. Yani today we agree at a specific price, and a price will be set today, but delivery will be on a specified future date. One of the very famous futures market, we have what we call New York Mercantile Exchange, NYMX, and the Kansas City Board of Trade, and the Chicago Board of Trade, CME, and the Chicago Board of Trade, CBOT, and we have what we call Chicago Board Option Exchange and the Minneapolis Grand Exchange. All of these things are the most famous types of futures market. You must be careful that you must understand the basic difference between spot market and futures market, and you must be aware of what is the purpose of using futures market. Actually, we are using futures market either for hedging or transferring the risk. Either we use it for hedging the risk or transferring the risk from one partner to another partner. Another classification of financial market, we could classify the financial market into, we have broker market versus dealer market. What are the broker markets? It's a market where the security exchange between two sides of a transaction are brought together to trade security. And most of cases in the broker market, they should have centralized trading floors of national exchange, such as New York Stock Exchange, such as the Egyptian Exchange. The Egyptian Exchange can be described, or New York Stock Exchange can be described as a broker market. Why the broker market? Because both buyer and seller are brought together on centralized trading floors, and then the transaction of the securities will be done. This is why it is called broker market. But in the dealer market, such as NASDAQ, this is a certain type of market in which buyer and sellers are not brought together directly, but they are going to execute their orders by what we call securities dealer, or what we call the market makers. But dealer market has no centralized trading floors. This is vice versa of broker market. The broker market, they have centralized trading floors, but in the dealer market they have no centralized trading floors. In the broker market, both of buyer and the sellers are meeting to conduct a specific transaction. But here in the dealer market, it consists of market maker, and those market makers are linked together through a mass telecommunication network, and through this mass telecommunication network the transaction will be conducted. Yani in very simple way, we could say that broker market, they have a physical location. This location is centralized, where a buyer and the sellers will directly trade the security, issuing their orders, and it will be done directly. But in the dealer market, this market has no centralized trading floors, but a transaction in this market will be done by using a mass telecommunication network, or it will be done through what we call market maker. Of course, what is the benefit of the market maker? To compensate a market maker for this role, they are going to have what we call spread. What's the spread? This is the difference between bid price and ask price. The difference between bid price and the ask price, this will be the spread, and this spread will be considered as a good compensation for market makers as they are conducting and executing the orders using a mass telecommunication network. Also, one of classification, we could classify the financial market into, this is local market and this is the international market. One of the famous international market, we refer to what we call the euro bond market. Euro bond market or euro bond market, in this euro bond market, corporation and the government typically issue bonds dominated in USA dollars, but they are selling these bonds to investors located outside the United States. But if you are issuing bonds dominated in USA dollars, but you are going to sell these bonds in market outside the United States, this will be considered the euro bond. And this is the difference between euro bond market and the foreign bond market. In the foreign bond market, It's a market where the corporation is issuing the bond, and this bond is dominated in the investor home currency. يعني we are issuing it in the investor home currency, and it will be sold in the investor home market. And this is the main concept of foreign bond, and this is the difference between euro bond. In the euro bond, we are issuing the bond dominated in dollars and selling to investors located outside the United States. But in the foreign bond market, we are issuing a bond. This bond is denominated in the investor home currency and selling in the investor home market, and those are a main good example of international capital market. As you see, by the end of this part, we have different classification of financial market. We have primary market versus capital market. We have money market and capital market. We have FX exchange market, and could be classified into spot FX market and forward FX market. Also, we have spot market versus futures market, and also we have the international capital market, such as euro bond market and foreign bond market. You must understand the basic differences between them. The last part in the capital market is to investigate what is the role of capital market. Actually, we have different perspectives. The first one from a firm perspective. From the firm perspective, the capital market can be considered as a liquid market, where the firm can interact with the investors in order to obtain the fund required by the firm. But from a firm perspective, capital market can be considered as a liquid market, where the firm can interact directly with the investor to obtain valuable external financing resources. The second perspective is from investor's perspective. From investor perspective, capital market can be considered as an efficient mechanism which allocates the fund to their most productive uses. And finally, the use of financial market could lead to increase the ways of owners of a specific firm, and also can be used to a fair identification of the price that could be believed close as possible to their true value. This means that financial market will help us to identify a price which is could be believed to be close to their true value, and I think this is the main role of capital markets. But again, capital markets play a very important role. From the firm perspective, capital market can be considered as a liquid market. Number two, from investors, capital market can be, if it is an efficient market, so it could be a very important role in allocating the required fund. Number three, the capital market will play a very important role in determining the current market price, which that is believed to be close to their true value, and this will enable us to achieve waste maximization of the owners or investors. This is by the end of this part, you must aware of what are the main components of financial markets. You must aware of what is the role of financial markets, different types of financial markets. Finally, we are going to end this lecture by discussing the concept of financial institutions. What are the main rules of financial institutions, why financial institutions are important, and the different types of financial institutions. Financial institutions, we refer to it by FIS. FIS, financial institutions, they doing an essential function by channeling a fund from those with surplus fund to those with shortage of fund. Actually, we have different types of financial institution. We have banks, thrifts, insurance company, securities firms, and investment banks, finance companies, mutual funds, pension funds. All of those are different types of financial institutions where they provide indirect mechanism of transferring the fund from those with surplus fund to those with shortage of fund. This is actually the main definition of financial institution. If someone is asking you what is the definition of the financial institution, you could say that financial institutions play a very important role, as it can be considered as an indirect way of financing a specific firm. How? By channeling the fund from those with surplus to those with shortage of fund. We have different examples of financial institutions. We have banks, commercial banks, investment banks, central banks. We have thrifts, we have insurance companies, we have securities firms, investment banks, finance companies, mutual funds, pension funds. All of them provide an indirect mechanism of financing. Let us imagine we have a world, but this world has no FI, has no financial institution. How is the case of this world? As you see, we have two partners. We have user of funds, such as corporation. Those user of funds are facing shortage of funds. On the other hand, we have suppliers of funds, such as households. Imagine that we don't have financial institution. We just have a direct mechanism of transferring the funds. What is the main problem of this system? If the system is existed where the world has no financial institution, you are going to suffer of the following disadvantages. One of the disadvantages due to the absence of financial institution, number one, low level of fund flows. Low level of fund flows. Low level of fund flows between the two partners, between suppliers and the demanders. If you give a look for a direction and the size of such a flow, you will find that this flow is very low. Why it's low? Because of, number one, information costs. Information costs. If you don't have financial institution, the collection processes of the data and the information will be very costly for your organization. Increasing such information cost, it will affect your economy of scale, and at the end, it will affect on the welfare of a specific society. Number two, if you don't have financial institution, the market will be less liquid because you just have one mechanism, which is the direct mechanism. But the existence of the financial institution, it will increase and will add a new mechanism of transferring the fund, and in this case, the market will be liquid. But if the FI is not existed, your market will not liquid enough. Another shape or another characteristics of the absence of financial institution, your probability of facing substantial price risk will be increased, because the existence of financial institutions and the role of the financial institution, it will enable you to manage and to reduce different types of risks, particularly price risk. In this matter, we could refer to the role of the financial institution. Give a look. This is the world, but the financial institution is existed. Means existed that the financial institution is working as intermediary, كوسيط. And they are able to provide two main functions: working as brokers or working as an asset transformer. The existence of the financial institutions play a very important role in the relationship between the users of funds and the suppliers of funds. This role can be split into two types of roles: financial institutions working as brokers or working as an agent to facilitate the selling and the buying process, and the second function, financial institution, they could perform what we call asset transformation. What is the meaning of asset transformation? Let us investigate what type of security existed in the financial market. Financial markets, we are trading different types of securities, such as stocks and bonds. Such a type of securities, of stocks and bonds, could be considered as primary security. This type of primary security, they have a specific financial claims on equity and the debt security in your firm. But the financial institutions, they are able to issue a new type of financial institution, this financial securities. This type of financial securities, it's called secondary securities. What are the secondary securities? Secondary securities are certain type of financial claims. Claims on the deposits and in the shape of deposits and the insurance policy. So the insurance policies issued by the insurance company can be considered as in a secondary security. It has been found that secondary securities is more marketable than the primary security. By the end of this part, you must understand what is the role of the financial institutions and why financial institutions are so important in the market. To give you further detail about it, the main function of financial institution, number one, is acting as a broker, acting as an agent for investors. If you are working as an agent, this will enable you to provide more data, information, knowledge, offering transaction services, reducing costs by achieving economies of scale. It will encourage higher rate of savings. Those are the main duties of financial institutions acting as a broker. The financial institution can act as a broker, and this will help the investors for, number one, getting information at a low cost, reducing the costs of data and the information, reducing the asymmetry of information. This enables us to achieve economies of scale, will encourage higher rate of saving. Another function of financial institution is that the financial institution is working as an asset transformer. What is the meaning of asset transformer? That the financial institution, as you see, the functions of FIS, they could working as a broker, acting as broker, or acting as asset transformer, acting as a broker or as an agent. They providing many service for investors, providing information, reducing costs, reducing asymmetry of information, which increase economies of scale, encouraging higher rate of saving. Working as an asset transformer, FIS is purchasing primary securities and issuing a new type of securities. It's called secondary securities. Such a type of secondary securities are often more marketable. Actually, we have different types of financial institutions, and you must aware of those types of financial institutions. We have commercial banks. Commercial banks, those are depository institutions whose major assets are loans and the major liability are deposits. The second types are thrifts. Those are depository institutions in the form of saving and loans, credit unions. Also, we have insurance company. Insurance company play a very important role in protecting individuals and the corporation from adverse event. Also, we have what we call another types of financial institution. We have securities and investment bank, and you must aware that investment bank play a very important role in helping a corporation to underwrite their securities, and they are engaging in securities brokerage and trading, also assisting companies in raising capital, providing advice for firms to conduct major transaction such as merger and acquisition. And finally, investment banks are engaged in trading and market making activities. Another form of financial institutions, there are finance companies that are different, certain type of financial institutions that make loans to individual and business. Finally, types of financial institutions, we have mutual funds and pension funds. Mutual funds, those are certain type of financial institutions. The main purpose of those mutual funds is to pool financial resources and invest in diversified portfolios. Pension funds, another shape of financial institutions, and they're offering saving plans for retirement. By the end of this lecture, I hope that you understood what is the meaning of financial environment, the main components of financial environment. We could split the financial environment into financial markets and financial institutions. You must understand the main definition of each one of them. You must understand the main function of financial market and financial institution, the basic differences between financial markets and institutions, and the different types of financial market and financial institutions. I wish for you all of the best, and see you inshallah in the coming lecture with my best